Going from a valuation in excess of £1 billion to an ultimate exit 10 years later of 33 million, where the equity investors, both the professional and the equity for punks, see nothing back. With preferred stock, which is the type of stock that venture capital and private equity firms are acquiring, it gives them protections. It gives them the ability to veto or to block small exits, like 33 million maybe. It gives them the ability to block and to have a say in strategic directions for a business, in changes to leadership. It also can come with board seats. Liquidation preferences give preferred stockholders a multiple of their investment capital paid back before the rest of the equity shareholders are paid. They loved the story and felt that they were also going to share in the upside success when BrewDog would have its big moment.
A company once valued at $1 billion has just been sold for £33 million. But what makes this story unusual isn't just the collapse in value, it's who invested. Up to 75,000 people backed BrewDog through crowdfunding. Many were customers, fans of the brand. Now the company has been sold, and those investors are likely to get nothing. So today we're asking a bigger question. When startups promise to democratize investing, who actually benefits and who really holds the power? I'm joined today by Dr. Robyn Klingler-Vidra, author of Startup Capitalism. Because BrewDog isn't just a story about one company, it's a window into how startup capitalism actually works. Welcome to Office Hours. Robyn, welcome. Let's start with BrewDog. What actually happened here?
So BrewDog, created just in the throes of the global financial crisis, had attracted a lot of fans and also investors. They, at one point, were valued in excess of £1 billion. So they were a unicorn about 10 years ago. And then within the last month, news of their sale was announced for £33 million. So a significant outcome down relative to what BrewDog was at its peak. Over the course of the story, BrewDog was, in addition to being quite popular and having physical locations and doing very well in stores across the country, they also created something called Equity for Punks. Part of the run-up to their £1 billion valuation was attracting, fans of the beer, of the craft, who were investing in this equity crowdfunding mechanism that gave them a share in the beer that they loved.
We think 200,000 equity punks in total, but the figure is probably more like 75,000. So this is a lot of people that have been affected by this.
So there's a lot of people invested over 10,000, so significant amounts of money, hoping that this would be something that they really loved backing. They loved the story. They were fans of the product and felt that they were also going to share in the upside success when BrewDog would have its big moment and finally materialize on its high value sort of exit.
What made BrewDog's model different from how companies would usually raise money?
BrewDog is obviously a craft, but a mainstream brewery, which isn't your typical startup venture capital type of firm. Normally, companies that we talk about in the unicorn space are tech firms, broadly defined, who raise money in their high growth ascent in that sort of J-curve or hockey stick uptick in their valuation. BrewDog, it wouldn't necessarily be venture capital backed naturally, but because it had this innovative positioning, this significant growth potential in the consumer vertical, it did ultimately attract in 2017 VC private equity investor. That would be the more typical growth path, that it's growth capital, that it's private equity investors, not the equity crowdfunding at scale to finance its growth.
You recently spoke to the New York Times along with Dr. Hadar Gafni and pointed to something important. The equity punks had ordinary shares. Professional investors usually get preferred shares. What's the difference and why does it matter?
So the equity crowdfunding, it's ordinary shares, common stock. It effectively means that you have less say over the direction of the business With preferred stock, which is the type of stock that venture capital and private equity firms are acquiring, it gives them protections. It gives them the ability to veto or to block small exits, like 33 million maybe. It gives them the ability to block and to have a say in strategic directions for a business, in changes to leadership. It also can come with board seats, and so board seat or board observer. Effectively, it gives a voice, it gives an ability to shape the growth trajectory of the company that you're investing in. It also comes with clauses around what happens at liquidation, that exit. Liquidation preferences give preferred stockholders the potential to have a multiple of their investment capital paid back before the rest of the equity shareholders are paid. So effectively, you have protection, control over the outcomes. We often think about preferred stock and its ability to shape the economic outcomes, but also the control over the course of the journey. So it's this ability to not be a passive investor.
So they were investors, but without the power that usually comes with it. Is that down to a lack of research, a lack of understanding how this works? It's quite a complicated field, and obviously you're an expert in it. We were talking before we started recording this that there's no crystal ball, and there's an element of risk of which we're reminded in every single advert that we hear for investing. Do you think there should be more being done to make people aware at this stage of before they're putting their money in, rather than trying to learn a lesson after the fact?
For venture capital investors, their expectation is that a number of the investments in a portfolio will be written off, will go down to zero. And so let's say in the classroom, we would say that, just to make the maths easy, if you have a portfolio of 10, if you have a portfolio of 10 investments that you've made, you would expect one of those to be a phenomenal outcome, right? That's the one that you hope is your unicorn. You would expect up to 5 to be complete write-offs, right? Go down to zero. And then you expect this sort of muddling through and maybe some small multiples on your return in the other 4. Part of it is an expectation about risk and diversification and what a portfolio gets you. Through follow-on funding, VCs would then double down or maintain their pro rata through to exit in those that are tipped to be the unicorns as they see things grow. With equity crowdfunding, it's about fans and consumers being excited about supporting a business, and not only as a consumer. It's coming from a different perspective. From the company that's raising equity crowdfunding, it's an important signal, because if you're able to raise crowdfunding in this way, it's a way of demonstrating that your consumer base is excited about you, not only in going and buying like a 6-pack at the supermarket, but also in the story and where you're going, what you need to know, and awareness. As a consumer, if you're looking at equity crowdfunding, it's about a signal, and some of this type of crowdfunding can also come with early access to products and emotionally connecting. If you are involved in equity crowdfunding, be aware that it can also go to zero. There can also be the potential for write-offs. So be careful with how much you're investing and what you're hoping to get back from it.
It was beer tokens over board seats, I suppose, was what they ended up with. Equity crowdfunding was meant to democratize investing, and the idea was that anyone could back a company they believe in. So does this case suggest that promise hasn't quite played out, and do you think people will be more fearful of investing in the future? We are reminded that the money we put in we could lose, which I think puts a lot of people off.
I think the awareness of risk and the potential, this is a really striking case, right? Going from a valuation in excess of £1 billion to an ultimate exit 10 years later, to an exit then of 33 million, where the equity investors, both the professional and the equity crowdfunded, equity for punks, see nothing back. It's an extreme example, and maybe a cautionary tale for that reason. And so I think for me, it's being clear that you're involved as an equity crowdfunding sort of member because it's something that you want to have this greater sort of emotional connection, but being very much aware that even when there's this trajectory that looks like it's sort of going to the moon, things can unfortunately crashing down.
Do you think there's a tension between building a community of supporters and raising serious investment capital?
In some ways, retail brands like this sort of want to do both, because having a mechanism for bringing together a community and having really strong validation around your product, your brand, is an important part of building any retail brand. Having the investment capital that allows you to grow at scale is another important piece. And I think what we are seeing here is that maybe the tensions come from the BrewDog side and seeing maybe conflating those two things, right? And so if from the crowdfunder perspective, you're hoping to have this greater attachment and involvement in a brand that you really like, the equity issuer, in this case, BrewDog, it's thinking, this is a way of building my community, not necessarily raising significant sums of capital. The deep pocket capital should come from more traditional professional sources who are able to finance that growth and deal with the potential for loss and the illiquidity that they'll have over the course of years as well.
We're always told to not look at our stocks daily and look at all the fluctuations that can be especially tumultuous, especially in the last 12 months with Trump's tariffs and that effect on the stock market and various wars around the world. We're told to zoom out. So what we're going to do now is zoom out slightly and see, what does BrewDog tell us about the wider system?
I think part of the BrewDog story is that it didn't have that sort of Cinderella exit, if you will, right? The £1 billion valuation comes in 2017 with the TSG investing over 200 million pounds and getting a 22% equity stake. That's what solidified that unicorn status. You would typically expect, and certainly the investors expected, that within, say, 5 to 10 years, there would be a liquidity event, there would be an exit. And I think part of the BrewDog story, not getting into issues about operations and financial management, but maybe also sort of scaling up in terms of number of physical locations, right? There's BrewDog restaurants, pubs around London, for example. I think part of the story is that there wasn't that exit opportunity. And the idea that a 2017 investment would then exit in the early sort of 2020s is the typical expectation. And that didn't happen. And I think partially that didn't happen because you mentioned wars and geopolitics. But I think part of it is we have COVID, you have the so-called IPO window closing. It wasn't a good time to go public. Perhaps there was a moment where the BrewDog story had its wonderful exit, but that didn't happen, and then it sort of muddled along. I think, unfortunately, that models what we're seeing in some ways in the UK. The IPO environment at, say, the London Stock Exchange is really low, and we have this issue of companies that are doing well, that are scaling up, that they tend to drift across the Atlantic to the US to seek deep pocket sort of growth investors, private equity, and then ultimately to be acquired by large firms, or if they are to go public on, say, NASDAQ or the New York Stock Exchange. And so it is maybe part of this wider story of there not being sufficient exit opportunities for BrewDog at the time it needed it, and then momentum was lost.
And what does IPO mean?
IPO is initial public offering, your public offering on a stock exchange. Private equity investment being translated into an offer for the public at large, able to buy through the stock exchange.
And then it becomes real.
It becomes real. It's this important exit moment for investors of a lot of different stripes who have had their equity ownership in a company that had that upward growth trajectory. When you exit, when it goes public, or when there's a trade sale, that's the moment to get your money back, plus the returns, the gains.
So when we talk about a scale-up problem in the UK and why you're saying that's not quite the right diagnosis?
There's a lot of debate and discussion and also newspaper headlines around the idea that there's a scale-up problem in the UK, but also in Europe. This idea that companies relocate, especially the good ones, the growth stories. I think that's part of the problem, but it's not the real problem. I think it's a symptom, not the ultimate problem. I would reframe it as we don't have a scale-up problem, we have an exit problem. And by that I mean we don't have the companies with corporate development teams buying high-growth startups for those, say, unicorn valuations. And we also don't have the stock exchange functioning in the way that we need it to or that we used to. The London Stock Exchange, unfortunately, is not a viable exit destination for companies that want to produce the greatest possible return for their employees, for their shareholders. It's, if you're thinking about fiduciary duty and this need to produce the greatest return for your investors, the London Stock Exchange isn't providing that. And so the high growth stories go to where they're able to access that deep liquidity and get the outcome that they deserve.
Governments are trying to fix this. There's been a lot of focus recently on funding, so more capital, more support of startups, more pension money going into venture. I suppose this Labour government is coming up to 2 years old, and there has been some onus put on removing the tax benefits of some savings and moving them to encourage investing. So would that solve the problem? And if it doesn't solve it on its own, what does it need to supplement it?
So the idea is that if we have more pension fund capital, allocating to funds at this stage, like if we think about private equity or private capital, you start with raising money from seed stage VCs to A and B, and then you get to growth rounds, then you get to private equity, and then ultimately you're looking at that exit, right, IPO or trade sale. It doesn't have to be that a company hits every stage. It could be the dream is that you raise maybe a round or two and then you have your exit. The super dream is that you bootstrap and then exit. But the idea, the Mansion House Accord, we also see in France, there's the TB initiative. The idea is that what we're missing, and the reason that we have the scale-up problem, is that we're missing that growth and later stage deep pocket money to keep the high-performing startups here. That, in my view, has been motivated by learning about the role of pension funds in the US and specifically a regulatory change that occurred that seems to be what we're sort of striving to replicate or to at least model after. And so in the 1970s, the Department of Labor changed its understanding of what's a prudent risk for pension funds. And so they changed the Employment Retirement Income Securities Act, ERISA for short.
We love an acronym.
Yeah. They changed ERISA so that pension fund money could flow into venture because now this is a prudent risk. And so the lesson that seems to be motivating a lot of policy initiatives here at the moment is the Mansion Fund Accord getting 17 pension funds to sign up to put more money into venture. So the idea is this drove venture capital to boost Silicon Valley in the US from the late 70s through the 80s. And so if we can get UK pension funds and continental European pension funds to invest more in this venture capital as an asset class, we can replicate the magic of pension funds for the US. And I think that's learning only a piece of the puzzle. We're missing a piece that matters a lot, going back to our exit point. ERISA allowed pension funds to allocate. So you have huge funds like CalPERS, which manages the California pension fund money, who invest in venture. But let's say they invest a small amount initially. It takes expertise, it takes resources to figure out how to invest in this asset class. If they didn't get great returns, they wouldn't have kept investing, nor would they have ramped up their investment in venture capital. So for me, ERISA was one piece, but then it's the fact that these funds had great exits, right? They saw the companies they invested in have major acquisition outcomes and also going public on NASDAQ. And that's the virtuous cycle. So my fear is that we're taking just the ERISA piece, but then if we sort of force or strongly encourage the fragmented pension funds in the UK to allocate to venture without the expertise, but then crucially without that potential for the virtuous, right, with the great outcomes, with the exits, with the London Stock Exchange which has now fallen out of even the world's top 20 IPO destinations. Right? So even Mexico City last year surpassed the London Stock Exchange. We're setting pension funds up for failure potentially, and that would poison the well, and then you see less money coming into the asset class.
Let's stick with Silicon Valley for a second. We talk about unicorns, we talk about rainbows with a pot of tax breaks at the end of them in Silicon Valley. Do you think the UK could ever become Silicon Valley on sea? I want to move it towards another area of your expertise, Japan and South Korea, and what they do differently.
First of all, on the Silicon Valley, there's already a moniker here, the Silicon Roundabout, right, which is around Old Street Roundabout. Like this idea of either you have a valley or a silicon and then you just chop and change. I do think that there's so much in the essential elements of an ecosystem already in the UK. Amazing talent, at least partially, if not hugely, driven by universities and the talent that we attract. The capital, right? London is one of the world's financial centers, despite the London Stock Exchange not necessarily being the outperformer for the last several years. There is significant abilities around particular industries and technologies. So a lot of the raw inputs are there. I look a lot at East Asia and innovation systems, something that I generally call startup capitalism. So this idea that startups fuel innovation, but also economic growth, and also are key mechanisms for economic and national security. So Silicon Valley is a version of startup capitalism where you have startups that are really tech, maybe historically, specifically software, and they're fueling innovation as the sort of David, like overcoming or breaking Goliath industries, right? So you have this creative destruction is what Schumpeter calls it. This is one mode of startup capitalism. But in my work on East Asia, I found with my colleague Ramon Pacheco-Pardo, who's also at King's Public Policy faculty, we find that in Japan and Korea, the model is fundamentally different, even though a lot of the language is the same. You'll hear about unicorns, but the key performance indicators and objectives in a lot of the government initiatives are from the other way around. So it's about injecting innovative DNA, the ideas and the talent from startups, into the large firms. So how can shipbuilding, how can precision manufacturing benefit by having startups complement what they're doing rather than usurp their position?
I'll put a link to your article that you wrote for the conversation in the description of this show so people can go in and see more about that particular angle. Somewhere, country like the UK, do you think that they will copy more the Silicon Valley model, or do you think we'll look at the East Asia model, or do you think it could be the hybrid, the two? Do you think we'll end up with a traffic light system?
So I think there's been a tendency to look to the Valley.
Mm-hmm.
I think, and that makes sense because the sort of outperformance in particular categories you can't deny. But I think there's specific lessons that can be drawn from elsewhere. For example, I think the UK is a middle power. Right? There's two great powers in the world at the moment, right? The US and China. And if the UK is a middle power, middle powers need to have something that brings a greater ability to have sovereignty, autonomy, to have weight on the international stage. I think there's a strong case for the UK learning from different models around the world, but cultivating what I've called a niche superpower, being world leading in terms of a market in a specific vertical or technology. Examples from East Asia, the Korean government packaged together capability and funding in this program called Make American Shipbuilding Great Again, MASGA. The idea of MASGA is leveraging Korea's world dominance in high-tech shipbuilding. Hyundai Heavy Industries alone in their Ulsan shipyard produces 10 times more high-tech ships than the entirety of the U.S. commercial or naval shipyards. And so putting that together and saying, this is how we matter, right? We can bring something that's real, that's important. The head of the U.S. Navy had said that the Navy's ability to build ships is a mess. That's a direct quote. So it's pulling together and leveraging those unique or asymmetric capabilities, right? The thing that you're indispensable in. And so there's a question about what is that for the UK? Last week, the government announced the $2.5 billion for AI and quantum funding. And it feels like the building of the specific centers around the country, there may be a trajectory where we're moving more towards focusing in that niche rather than what's tended to happen of the industrial growth sectors where you map more broadly.
Let's bring it back to the individual level for a moment and back to BrewDog and the equity punks who thought they were part of something, but financially they had little power. So what should people understand, whether they're investing or just watching these companies grow, that they are fans of and they like the idea of?
To have skin in the game is worthwhile. It's just always doing it at a level budget that fits with your lifestyle, right? Or with your plans, knowing that if you are investing in this mechanism, you don't have the preferred stock and all of the protection powers that come with it. You're investing in ordinary shares. So it's an expression of your love for a brand and your desire to see something grow. And it may lead to a great payout in the end. It may lead to liquidation at that unicorn status, but it also can go to zero. So only put money at risk that you're comfortable losing completely.
Is this why index funds are so popular generally? Because it is such a diversified portfolio. Would you call it boring? Would you call it boring investing? I don't know.
Not if you're thinking about the stock market for the last however many years, having access to an index that's tracking the great companies that have been growing so much year on year. Boring maybe, passive maybe, but great returns absolutely. I think it's also the reason that alternative asset managers like hedge funds, venture capital, they're employing other people's money, and the other people's money that they're putting at risk are qualified investors. It's individuals with a certain amount of money, six figures, in liquid assets. I think that sort of awareness or understanding that putting money at risk, where you're putting all of your chips on just one specific bet, is not something you should do unless you're able to lose the money and still go on with your life as normal.
Thank you, Robyn. BrewDog looks like a story about one company, but it's really a story about how the system works. Who gets access, who gets influence, and who gets paid when things go right or wrong. BrewDog's equity punks were invited to the bar. They just weren't told they had no say in last orders. You've been listening to Office Hours. Make sure you drop us a follow, subscribe on YouTube, and if you've got any questions for Robyn, email us via business@kcl.ac.uk.